Hey everybody, welcome. Thank you so much for joining. My name is Matthew. Today we're going to continue with the U.S. national debt analysis. Going to start with the 1980s and bring it forward till today. So continuing where we left off yesterday here with this analysis, we have the U.S. federal debt, total public debt. Of course, that does not include the off-budget balance sheet items, the off-balance sheet items of Social Security, Medicare, and Medicaid, the entitlements. These are sacred cows. It's just not included in the national debt. The U.S. likes to do it. Not all nations report their balance sheets this way, but that's what the U.S. does. Nonetheless, here, the on-budget debt is rising. We see, as I mentioned at the end of the last video, kind of institutionalized now. It's just steadily rising no matter what. That is both the total debt, which is issued by the Treasury every month, every week actually. They make auctions of various maturities. Even though this is a monthly frequency here, yes, the national debt is basically increasing every week. We have this sort of constant growth that we're seeing here after the Vietnam War. But interestingly, as you see, and as we left the video off yesterday, when the Vietnam War ended, the percentage of the debt that the Federal Reserve itself owned from open market operations topped at about 18% here in the mid-70s, and then it started to fall. And it fell and fell and fell here all through the 80s. A couple things I want to show you in this video of both the Federal Reserve's portion of the U.S. federal debt and the total U.S. federal debt on balance sheet federal debt. The first thing is the 80s and Ronald Reagan. So the U.S. is rising to be the sole dominant superpower of the world. It wasn't known in the 80s. Gorbachev was coming to power. The Soviet Union was weakening, but the Soviet Union was trying to be more market, open, glasnost, perestroika. It wasn't known that the Soviet Union would collapse as it did and dissolve as it did in December of 1991, but it was definitely weakening, and the United States was rising to be the sole power. Nonetheless, a huge part of Ronald Reagan's ethos, his mentality, his rhetoric for sure, was, the original Make America Great Again candidate. A huge part of his rhetoric was balanced budgets, responsible government. Remember, government is the problem. Certainly things that I think most classical liberals, libertarians, people that like freedom like myself appreciate. But as Ron Paul, the great Ron Paul has said, and his son Rand Paul as well, actually look at the facts and you'll see something a little bit different. What happened to the national debt during Ronald Reagan's tenure when he came in here in 1980 and when he finished in December 1988? What happened? Well, as Ron Paul and Rand Paul always say, he doubled the debt. And in fact, he didn't just double the debt. Remember, we stopped yesterday when we hit $1 trillion in debt. October 1981. So we're around $1 trillion when Ronald Reagan comes into office, a little bit under. When he leaves here, roughly around here, January 89, December 88, $2.68 trillion. So it wasn't just a 100% increase, it was a 150% increase in debt and a little bit more. Again, it's just a fact of life. I think when you're talking about any institution, any agency, look at what they do, not what they say. And this applies no least of all to the United States government. So the debt rose all through the 80s, even though the Federal Reserve's portion, although it rose nominally on a gross level, it rose as well. The percentage fell. The percentage fell from 18% all the way to the start of the 90s here to 7% of the total debt was owned by the Federal Reserve. I'm going to explain more about what that actually means here just in a second, but let's keep going. Okay, so we're going to zoom out, pick it up where we left off, and let's go to, say, the global financial crisis. The other little tidbit of information that I want to throw at you here in this video is the 90s, the Clinton years, talking about good old balanced budgets. Okay, remember all the fanfare that Bill Clinton got for this with his divided Congress led by Newt Gingrich, which is a good thing typically, right? When you have Republicans and Democrats, which either can only reach agreement by compromise or don't reach agreement at all on issues perhaps that they shouldn't be spending time on. it's possible that expenditures can fall. But let's just define really quickly what a balanced budget means. Okay, so the budget, that's a income statement thing. The budget has only to do with a period of 1 year, one fiscal year. Okay, this is controlled by the Congress. Congress controls the purse. So taxes come in, as I'm sure everybody loves to pay, and government expenditures go out. And you record these things during the fiscal year. So when we talk about a balanced budget, what does it mean? It basically means that taxes, all right, the things that come in, are matching the expenditures, the spending, the things that go out that government spends on for a period of 1 year. But the key there is that it's a period of 1 year. Often we think that this is like, Bill Clinton extinguished the national debt. Did he do that? Not at all. He did, though, with Newt Gingrich and this divided Congress, balance the budget for a period of 4 years. It was his second term. Let's just zoom in here again and let's just look. Let's look at where we can see here. I know it's hidden a little bit by the tooltip. The national debt is still rising. This might not be captured perfectly. I mean, these numbers do come from the Treasury, but nonetheless, what we should see basically is a flat national debt because, again, taxes are coming in that are matching, or at least it's somewhat of a surplus even, to expenditures that are going out. And let's just start here in, say, January. Let's start December 1997, $5.5 trillion. Let's go till through 98, 99, 2000. Let's go 3 full years. Pretty close. So maybe that's enough to call it a balanced budget. Again, once 2001 came along and both the dot-com bust and more of a Wall Street panic, as well as the 9/11 tragedies, debt rose, of course, more. But we stayed roughly from the late 90s to the dawn of the new millennium, until 2000, 2001. We stayed at roughly $5.5, $5.6 trillion. That's all that it means to balance the budget. It means that your incomes match your expenditures. So, again, some people talk like he extinguished the debt or something. I mean, it is great to balance budgets, but it's a whole it's a whole different thing when you talk about actually paying this debt off. Basically, the balanced budget means income matches expenditures. And then look at it when the budget is not balanced. What does that mean? Well, when expenditures or spending is more than your taxes, what happens to that deficit? The deficit is added to the debt. That is precisely how the debt is calculated. It is simply a stacking of all the deficits from prior years. Okay, so with that in mind, if you look back again, you can see, again, from under 100 million, 80 million in US dollar total national debt around the founding until the dawn of the millennium. Again, the start of the 80s was 1 trillion. Tack on another 4.6 trillion in only 20 years. You can see how this stuff certainly compounds, and that's how it goes. But you can see here, you can definitely see this curbing of government expenditures. And I do say, if you're a classical liberal, libertarian, limited government type of person, which generally I am, it's definitely good that they were doing this. But you also got to put this in context. The same thing we said with Ronald Reagan, the same thing that we can say with Bill Clinton, although interestingly in a little bit of a more positive light with Clinton as far as the divided government went. It's going to take a lot of effort to ever get this thing paid off. And, to go back to the days of Andrew Jackson, 1835, when it was completely extinguished, it seems almost unthinkable at the moment. But nonetheless, that's a little bit of just two interesting histories there that I wanted to show you. Both the 80s, Reagan taking the debt up 150%, and then Clinton, yes, balancing the budget for 3-4 years at the end of the 90s, but really not doing anything to certainly what was to come after, which nobody could foresee, the dot-com crisis and 9/11. I'm not saying that they are merited in exploding the debt as they did, but that's the story. So now that we've covered the 90s and the 80s, let's move into global financial crisis and more activity from the Federal Reserve. And this is where we're really going to be able to see how to make sense of the Federal Reserve's ownership of government debt versus the just general size of the government debt itself. All right, so the debt grew and grew and grew after 9/11. Of course, the United States invaded Iraq and Afghanistan with only Great Britain by its side in the start of the 2000s, and the national debt just continues to rise as it has. The Federal Reserve's portion rises as well nominally, although as a percentage of the total, it does not rise. Now, you notice a very steep decline here. What is this? Well, the Federal Reserve, from when Bear Stearns started to be liquidated in 2007, the bad mortgage-backed securities hedge funds that Bear Stearns had were liquidated, and many market funds started to go under and break the buck. There was both fiscal stimulus and monetary stimulus. And the reason that, the Federal Reserve had not started on QE yet, we've talked about this, of course, in many, many videos, but as we get to the eve of the global financial crisis, you see this dip, basically. Nominally, the Federal Reserve is not having as much securities on their book, government securities. They had, maybe at their peak just before they hit 800 billion, no, 780, $790 billion worth of securities, 9% of the total debt. And then it starts to fall, and it falls drastically during the 2008 crisis. What is that? That is corporate monetary stimulus. The Federal Reserve is engaging with the federal government together to bail out the banks. So there's a lot of commercial paper that is taken on the Federal Reserve's books at this point, and that's why the percentage of government paper that's on the Federal Reserve's books declines. It's a very small period. Eventually, the Federal Reserve takes on a lot of mortgage-backed securities as well during QE1, QE2, and QE3. That's this point. And that is included in the national debt. Those are government securities, even though they divide them up between agency securities and traditional government securities. It's all has the same interest rate. It's all part of the national debt. So it rises. It rises rapidly here during the global financial crisis. After the TARP and the TALF and these fiscal bailouts, which, again, remember, the United States taxpayer took on AIG for a time and all the rest. There's a lot of both fiscal stimulus and monetary stimulus that's happening for corporations and bailouts during this time in late 2008. And then we get the mortgage-backed security bailouts that happen monetarily here. Okay, so that's really what QE 1, 2, and 3 is. There's a lot of government securities as well that the Federal Reserve is purchasing from banks to give them an influx of bank reserve liquidity on their books. But a huge portion of this is mortgage-backed securities, and that is here QE1, QE2, QE3. You see these bumps both in the percentage terms and in the gross terms of the Federal Reserve, massively increasing its portion of United States government debt securities on its own balance sheet. To where, once the corporate bailouts were happening, which really, of course wasn't a good thing, but actually took the percentage down of government debt on the Federal Reserve's books, down to under 5%, which is a very, very low number compared to recent history, last few decades. Quickly jumped up to 15% QE1, 18%, 18.5% QE2, and eventually 23%, 22% at QE3. So when it was all said and done, when the dust settled from the global financial crisis, you had $17.9 trillion of debt as Obama is nearing the end of his 2 terms. Get over $18 trillion in debt. And remember, when Obama started, the financial crisis was just starting as well. December is the best way to show it. December 2008, $10.7 trillion of national debt. It had just faced the big bump at the end of the Bush years, right? The glorious exit of George Bush, and $10.6 trillion in debt by the time Obama left office, which is going to be December 2016. QE is trying to be unwound a little bit through 2014 and 2015 and 2016. We get to December 2016, the debt is $19.9 trillion. So again, the debt, it doubles. Not a full doubling, but it basically doubles. I didn't actually show you in Clinton's, in the 90s, the gross change, right? Which is important to take into context, even though you hear, 3 or 4 years of balanced budgets with Clinton. Clinton came in 93, January of 93, So the end of 92, the debt level is 4.1 trillion. And by the time Clinton left, he actually had the best record. All right. His divided Congress of the 90s. By the time that he left, 5.6 trillion. So not even a doubling, not even a 50% increase in the debt for Clinton. So that is, I guess, all things considered, commendable. Anyway, we talked about the crisis. We talked about the increase of the balance sheet. And now let's bring it forward till today. Of course, with COVID, another huge bump. They couldn't not do it, apparently, when the world was collectively losing its mind in March of 2020, March and April. Massive corporate personal stimulus again, treasury checks being sent out again. What does that mean? It means you're going to have to increase issuance of the national debt. You're going to have to issue more debt because this stuff, again, we're already spending beyond our means. This isn't even including Social Security, Medicare, and Medicaid. They're going to have to issue more bonds, and they do. So here's where we can see what is the point of this, right? When these QE1, 2, and 3, and then this COVID massive bump takes the Federal Reserve's ownership of debt now up to nearly 30%. Okay, it tops at 28.3%. What does it mean? Well, again, the national debt is fiscal. Okay, so this is the Treasury, this is Congress. This is the national debt having a reflection of the United States' fiscal spending, fiscal policy. Okay, always increasing, except for the time of Andrew Jackson and after the Civil War for a few decades, but always increasing generally, always spending more, very much becoming institutionalized. But it's a fiscal thing, okay? It's fiscal stimulus. This is monetary stimulus in the dark green. In the dark green, when the Federal Reserve purchases this national debt, there's no other way to say it other than monetary stimulus. Because who controls the currency? Who controls the issuance of dollars? That's not the Treasury. It used to be, but it's not since the founding of the Federal Reserve. Since the founding of the Federal Reserve in 1913, opening their doors in 1914, it's the Federal Reserve that issues new dollars in the form of both physical notes and in the form of commercial bank reserves, which really explodes. And that's on the liability side of the balance sheet. Again, I'm showing you securities, assets that they hold. But on the liability side, banks are being credited with money that's being freshly printed digitally ex nihilo. And the Federal Reserve is taking that newly money, crediting it to banks, giving the banks the asset, and then the Federal Reserve takes another asset from the banks, which is their government securities, onto their books, the Federal Reserve's books. And so that constant increasing as both a nominal increasing into the trillions now. You see, we went up to 4.2 trillion here by the end of QE3. I didn't even tell you the nominals, right? And by the height of the COVID stimulus, it's somewhere around $8.5 trillion of U.S. government securities that the Federal Reserve owns on its books. Okay, 28% of the total national debt. So that is monetary. It's monetary stimulus. It's literally money created ex nihilo that the rest of the marketplace has not used to buy treasuries. What do I mean by that? I mean, the Federal Reserve is a monopoly. It is a monopoly, a central bank granted the right to print money ex nihilo from the United States Congress, all right, for over 100 years now. It doesn't hold 100% of the debt, but it holds a huge portion, bigger than it ever has, all right, 28% in November of 2021, 28%. And that is falling now, but still, the trend is clearly up. It's clearly up from the 5% that it was on the eve of the financial crisis, even though, yes, they were doing a lot more corporate bailouts at the time, the Wall Street bailouts. This is what it means when they say monetizing the debt, okay? Because for every dollar of debt that is in this dark green whale portion here on the chart, it is a dollar of debt that is not being purchased by a hedge fund, a pension fund, a bank, or even a foreign bank, or a foreign government for that matter. And it is true that foreign governments can print their own money as well and buy U.S. government bonds. That's absolutely true. China has probably most famously been doing that in the last couple decades. Nonetheless, for every dollar that exists of United States on balance sheet government debt, 25 cents, a quarter of it, is bought and owned by the Federal Reserve, which prints money ex nihilo, buys that debt, from banks and puts that debt on its own balance sheet. So it's pure monetization of the debt. So that's the way you need to think about what this is. We have the light green, which is fiscal stimulus. It's, we can talk all day about whether the debt is too high or too low, whether it should or could even be paid off. We can talk all day about that. But if you want to just look at it, see what it is, the light green portion is fiscal stimulus. It is the government spending beyond its means of what it takes in with taxes on projects, whatever it is. And remember, it's not even entitlements, but it's roads and stimulus and all the rest. So government is fiscally stimulating the economy and becoming a big portion of the economy itself, just the government. We'll talk about how big in future videos, but to the tune of $30 trillion big by today, $31.5 trillion big. And, this isn't the first time. This always happens in the media right now. Apparently by summer, the U.S. will face the risk of a government shutdown again. Does it mean the government will be completely expunged and stop by June? Of course not. Just means until they can come to an agreement, Republicans and Democrats, on when and how to raise the debt ceiling. Until they come to that point, spending will be paused. But they always come to an agreement, all right? They can't not come to an agreement with how much money is in it for them. I mean, do you think, just looking at this chart, that they're just miraculously going to stop spending and stop raising the debt? It's just trivial to say that it won't be. It's becoming institutionalized. But what, of course, is more of interest to me, and I assume viewers of this channel, we're probably Bitcoin bugs, gold bugs, just hard money, conservative type of investors or viewers. And again, this is not financial advice, but the whale here, the dark green portion of this picture, is bigger than it's ever been as a portion of every new dollar of debt issued. 25 cents now is being bought by the Federal Reserve, all right? And it's being bought, by the way, from both banks and non-banks, because there's this reverse repo facility, which is really a repo for the Federal Reserve that's also on their balance sheet. So the Federal Reserve is buying debt in every which way that it can. The balance sheet is increasing in the last few weeks due to the SVB banking crisis. Again, the national debt limit will have to be raised. I'm sure it will be. I'm sure the debt won't be expunged or just stop. But this is all that they can do, is when other pension funds, hedge funds, banks, non-banks, money market funds, foreign banks, foreign governments, when all of these parties, or you and I even, you can go to Treasury Direct and buy treasuries yourself, when all of us fail to buy as much government debt as they want us to buy, the only other option is to monetize it. The only other option is to have the Federal Reserve, the central bank, the monetary authority of the United States come in and purchase more. Purchase the difference. That is monetary stimulus. So what you're looking at is the cumulative value of both. The cumulative value of the United States' fiscal stimulus over its nearly 250-year history is $31.5 trillion. And the cumulative value of the United States monetary stimulus over the last 100 years, 108 years, for as long as the Federal Reserve has been around and printing money, is $7.9 trillion. That is how many government securities they have purchased with money that they created ex nihilo. It's a quarter. It's a quarter of the debt. The trend, you can clearly see where it's been, where it's going. It's going up. And again, just to finish the thought of all of this, the risk is, of course, now to the dollar. Again, I don't want to be a doom and gloomer. I don't want to encourage you to necessarily do one thing or the next. It's just trying to educate on the history of all this stuff. We can see the trend. We can see how this is certainly higher than we've ever been. Yes, it's down from the tippy tip top of nearly 30% in 2021. Here in March 2023, we're down from that top, but only 3 percentage points down. And it doesn't necessarily look any better from that perspective. So lots to take in with this video. I'm never sure with these little mini series that I start, how long they will be. I think I can do one more tomorrow to just sort of conclude the whole picture. But hopefully what you take from this, Reagan increased the debt 150%. Clinton actually only increased it by, $1 trillion and a half from a $4 trillion base. Relatively speaking, not bad in the 90s, but still, balancing the budget for 4 years has nothing to do with the long-term problem of dealing with now a $31 trillion debt. It has nothing to do with it. And to make matters worse, 25% of every new dollar issued of debt is monetized. It is money that is created with United States seniorage ex nihilo by the central bank. Thanks for watching. Take care.